A transaction is an event occurring in a business that results in a financial change. Each transaction has to be accounted for on the books of the business. First, we will examine a typical beginning of a business, the owner investing $2,000 in this new business. Every transaction affects two or more accounts. The first step in analyzing a transaction is to decide which accounts have been affected. In this case, the accounts that are affected are cash and capital. The second step is to classify the accounts as assets, liabilities, or owner's equity. Step 3 is to determine whether the accounts are increasing or decreasing. In this case, cash, the asset, is increasing by $2,000. Capital, the owner's equity account, is increasing by $2,000. Recall the accounting equation. Assets equals liability plus owner's equity. Assets have increased by $2,000. Owner's equity has increased by $2,000, so therefore the equation remains balanced. Let's look at another transaction. The company purchases a computer on credit for $2,500. What two accounts are affected? The equipment account and the accounts payable, because we didn't pay cash for this computer. Equipment is an asset account and accounts payable is a liability account. The equipment account increases by $2,500 because we now have a computer, and the accounts payable increases by $2,500 because we owe that money for the computer. Examining the accounting equation, assets equals liabilities plus owner's equity, we can see that assets have increased by $2,500 and liabilities have increased by $2,500 so that the equation is still balanced. Now for a third example. The company purchases supplies for $50 cash. The two accounts affected are office supplies and cash. Office supplies is an asset account and cash is an asset account. Office supplies increase by $50 and cash decreases by $50. Looking again at the accounting equation, assets equals liability plus owner's equity, you can see that assets have increased by $50 and decreased by $50, so therefore the equation remains balanced. Our last example uses more than two accounts. The company purchases land for $100,000 and pays $25,000 cash and owes the remainder, $75,000, as a mortgage. The accounts used for this transaction are cash, land, and mortgage payable. Cash and land are both asset accounts, and the mortgage payable is a liability account. Land increases by $100,000, cash decreases by $25,000, and the mortgage payable increases by $75,000. Again, examining our accounting equation, assets equals liability plus owner's equity, you will notice that assets increase by $100,000, decrease by $25,000 because you've paid out cash, and your liabilities, the mortgage, increases by $75,000. Both sides of the equation remain the same and the account is balanced.